Stocks are recovering from an earlier slide today, and that should be no surprise to our next guest. Thomas Lee, Chief U.S. Equity Strategist at JPMorgan Chase, is predicting a stock comeback based on what he says is a show of capitulation by U.S. investors. We're pleased to have Mr. Lee join us now from his office in New York. Welcome to Bloomberg.
Thanks for having me.
So your research shows a gap that you're detecting here between the bulls and the bears, and you say that the fact that it's leaning toward the bears, we're showing it on our screen right now, signals a bull market or some more optimism now that stocks will rebound. Why is that? Explain your research.
Well, you know, we've been using the dispersion, so the difference between the bullishness and the bearishness on that AAII survey for several years now, and that survey has a pretty good history. It's been published since 1987. It's a weekly survey. Historically, at the extremes, it's a contrarian indicator. So whenever you see a majority investors more bearish than bullish, and you can measure it by subtracting the bullish minus percentage if it's a negative number, historically stocks do pretty well over the next 6 months, and we've seen that. You know, that it's basically a 76% hit rate, meaning the S&P is likely to be higher 76% of the time. It's really kind of a way to measure capitulation at the extreme. So I think that's one measure. We've definitely sensed it talking to investors as well. You know, that their conviction about fundamentals is now overwhelmed by the fragility of their confidence because of the headlines we're seeing, you know, out of Europe, out of Washington, out of China, as well as the Gulf oil spill. So,
in your research, you use the term analysis paralysis. Would that apply in this situation that you're describing?
That's exactly right. You know, because historically, even if someone was sort of detached and saying, okay, well, what are we really looking at? We're looking at large businesses today, large cap companies that are in very, very strong financial shape, pretty decent visibility, and we're seeing that with the ISM data today. But investors still unwilling to sort of buy, you know, with the fear that, you know, another flash crash is around the corner, or that some headline could knock the price point down another 5%. So investors are really seeing attractive buy points and unwilling to buy stocks. So to us, that's another example of potential capitulation as well.
But Tom, what's going to change that? Because it's not just the fact that we've had this big sell-off that causes people to come in to buy. You say in your note that these investors you've been talking to lack sort of a catalyst. So what is that catalyst going to be? Could it be the jobs report on Friday, for example, or what other news points are you looking at?
Well, that's a potential. Like, you know, if you start to get on balance enough positive headlines to offset the negatives, I think that's a catalyst, right? We sort of cumulatively rebuild confidence. I think another way we see a catalyst is the sort of the state of panic just begins to burn itself out. In other words, investors have this huge wall of worry. Then we just wait for the next negative headline, and if stocks don't go down on that next negative headline, we know that basically the state of panic is burning itself out. So you know, another catalyst is the lack of reaction to a negative catalyst.
So at this juncture, would you invest all systems go across the board, or are you still strategizing a little defensively?
Well, I think it pays to be a very slow buyer right now. The reason we're probably not, you know, sort of jumping in with double fists here is that corporate credit still looks like a stressed market. You know, we've had outflows out of corporate credit. You know, spreads are still widening, and then issuance is light. Now, the reality is that high grade and high yield markets are probably going to turn in tandem with all risk markets, so it's all going to happen at the same time. But the fact that we've seen those markets still under stress means it's going to be tough for equities to make big moves without sort of a confirming move coming from other risk assets.
Hey, Tom, when you're talking about just stocks at this point, you're looking at some of the most battered groups as perhaps creating the most opportunity, and you created a screen for that. I see energy equipment on that list. That's the one that stood out for me, given the recent events in the Gulf. But then the other screens you applied maybe got rid of that particular group. Talk to us about what groups you're looking at.
Well, I think that we're still kind of working under the view that this is a correction. Now, this is obviously much deeper than any correction since March '09, but it really fits within the parameter of a correction, and a pretty normal correction in a bull market. And if you looked at '87 as an analogy, or really any other period, when you have these types of corrections, the groups hit the hardest typically bounce the most. So that does mean, you know, whether it's in June or July when the real rally begins, you know, you're going to see the basic materials, the steels, the energy equipment, you know, those groups which got hit hardest rally the most. But I think what we're trying to look at now is if you're being a slow buyer, you want to look at free cash flow. So that's what we've been screening for recently.
All right. Thomas Lee, Chief U.S. Equity Strategist at JPMorgan Chase. Thanks for your time.